Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2025 December 22nd, and the markets are doing that end-of-year thing where they pretend to be calm while quietly rearranging your portfolio.
I love when markets pretend to be calm. That's like when a toddler goes silent in the other room. You don't relax, you sprint. So what's the silent toddler situation today?
Three big threads. 1. Gold is flirting with about $4,400 an ounce, and other metals are hitting records. 2. Tech is powering equity gains, Nasdaq 100 trying to erase December's losses. 3. China just slapped provisional duties on EU dairy up to 42.7%, effective tomorrow, December 23rd.
So the menu is shiny metal panic snack, tech dessert, and a tariff cheese board. Great. Let's start with gold at $4,400 because my group chat is already acting like we're all moving into a bunker made of bullion.
Here's what happened. Multiple reports today point to gold breaching around $4,400 per ounce, with silver and copper also pushing to record highs. The common story is a weaker US dollar and investors leaning into the idea of future rate cuts, plus concerns about fiscal deficits and policy uncertainty.
Okay, explain it like I'm 5, but a 5-year-old who has a brokerage app and poor impulse control. Why do rate cut vibes make gold go feral?
Simple version. Gold doesn't pay interest. So when interest rates are high, holding gold has a bigger opportunity cost, like choosing a couch that doesn't recline when every other couch does. If investors think rates are headed down, that opportunity cost shrinks, and gold looks more attractive, especially when people want to hedge.
So gold is basically the friend who only becomes popular when everyone else stops offering free snacks. Got it. But copper, too? Copper feels less bunker and more construction site.
Exactly. Copper is a growth and electrification tell. Wiring, grids, EVs, data centers. When copper rallies hard, it can signal strong industrial demand expectations, supply constraints, or both. For everyday people, that can feed into costs for anything metal-heavy, appliances, cars, even parts of housing construction.
So my inflation is over victory lap might get tackled by a coil of copper wire. Cool. Actionable question. If gold is screaming, do normal people chase it? Or is this how you end up buying the top in a shiny costume?
Actionable framework. Treat gold as a diversifier, not a lottery ticket. If you want exposure, think small and rules-based, like a 2% to 10% range depending on risk tolerance, and rebalance instead of all-in. When prices spike, rebalancing forces you to trim, which is the opposite of panic buying.
So the plan is don't propose marriage to gold just because it wore a nice outfit today. Understood. Now let's talk stocks, because I heard tech fuels equity gains, and my brain immediately pictured a laptop chugging gasoline.
What happened? A markets wrap notes revived appetite for technology stocks, pushing broad equity gains, with the Nasdaq 100 poised to wipe out December's losses. At the same time, the rally is happening alongside record moves in metals, so it's not purely everything is fine, it's more positioning is shifting.
Revived appetite. Is this investors being rational, or is this the annual tradition of performance chasing so your cousin can brag at dinner?
A bit of both. Rate cut expectations tend to help long-duration assets, tech especially, because a lot of their value is tied to future cash flows. Lower discount rates make those future dollars worth more today. But late-year flows and positioning matter too, and thin holiday liquidity can exaggerate moves.
So tech is like buying a house based on the promise of a pool you'll build in 5 years. If mortgage rates drop, suddenly that imaginary pool feels very real. But what's the don't be dumb checklist here?
3 checks. 1. Don't confuse a bounce with a new trend. Zoom out to your plan. 2. Diversify across sectors and factors. If tech is already a large chunk, consider adding balance rather than piling on. 3. If you're adding risk, do it with a schedule, like weekly buys, so you're not hostage to one headline.
Weekly buys, the financial version of don't text your ex at midnight. Put guardrails in place. Okay, now let's do the least fun but most real-world topic, tariffs. Because dairy tariffs sound boring until your grocery bill starts doing parkour.
What happened? China announced provisional anti-subsidy duties on dairy imports from the European Union, ranging from 21.9% to 42.7%, taking effect on December 23rd. The stated rationale is alleged harm to China's domestic dairy industry, and it's also framed as part of broader trade tensions.
I'm sorry, 42.7% is not a tariff. That's a jump scare. Who actually pays that? Europe, China, or my latte?
Tariffs are paid at import, but the cost gets negotiated through the supply chain. Sometimes exporters cut prices to keep volume. Sometimes importers accept lower margins, and often consumers see higher prices, especially if there aren't easy substitutes. The impact depends on competition and demand elasticity.
So it's like splitting a restaurant bill with someone who forgot their wallet. Everyone argues, and somehow you still pay more. Investing angle. What should listeners watch? Who gets squeezed first?
Watch for margin pressure in companies exposed to cross-border dairy trade and knock-on effects in related categories like infant formula, specialty cheese, and food service supply chains. More broadly, it's a reminder that geopolitics can reprice boring sectors quickly. So diversify internationally, but don't ignore policy risk.
Today's vibe is tech is partying, metals are building a panic room, and trade policy is throwing plates at the wall. Can we give people a clean do this now checklist before they start panic shopping gold coins and Parmesan?
Quick recap and action plan. 1. If you want gold, size it modestly and rebalance. Don't chase spikes. 2. If tech is running, stick to your allocation and consider staged buying instead of lump sum FOMO. 3. Tariffs remind us to expect price noise, keep a cash buffer, and avoid over-optimizing your budget around perfect inflation forecasts.
And if your plan is, I'll just time the top and bottom perfectly, congratulations on your new career in fantasy fiction. Subscribe to BD Daily Finance News Podcast and send this to the friend who thinks gold only goes up because it's shiny.
Thanks for listening. If you want more episodes like this, follow the show and check the description for today's highlights. We'll be back with the next briefing. Same feed, same mission. Make the money news usable.